Alright, here's the buzz, here's the deal, here's what's happening. This video purports to be a business finance class in one question, but that's obviously not the case. It's a simple capital budgeting problem, but it introduces a lot of the concepts you'll need in your first business finance class. Capital budgeting means making a decision about investing in a new capital project. Maybe it's buying a new store, buying a new warehouse, building a new distribution center, buying a new piece of equipment. In this example, Lucy Inc. is a publicly traded corporation and they're thinking about buying a machine that'll cost $2 million. They predict that they'll get $500,000 a year in new sales from the product that this machine produces, and that they'll have cash expenses of $100,000 a year. If it helps, think about that as the salary of the guy who has to work this machine. We have to pay him in cash. It's also another expense. There's depreciation expense. We're going to write this thing off over 10 years using straight line depreciation. Our incremental tax rate is 40%. That's 30% for the feds and 10% for the state. So the next dollar of income we make is going to be taxed at 40%. Our right-hand side of the balance sheet is half debt and half equity. Our long-term debt, if we went to borrow money today, we'd have to pay 3.33%. The government is offering its long-term bills at a 3% rate. That's a risk-free rate. There's no risk to buying government bills. And the company's common stock has a beta of 1. In other words, it moves exactly as the market moves. It doesn't move any more. It doesn't move any less. And to get people to even think about investing in the stock market, we have to offer them a premium of about 7% above the risk-free rate. The company doesn't pay any dividends on its common stock. So, how are we going to attack this problem? First, let me tell you a story. I was thinking about opening up my own mortgage company. So I was going to lend money to finance and accounting students because I think they're a good credit risk. But I don't have any money, so I go to my rich uncle. I say, hey, rich uncle, will you lend me $10 million? And he says, sure, I'll charge you 5% interest. So the right-hand side of my balance sheet, the only capital I have is debt at 5%. So if some student comes in and wants to borrow money from me and pay me 4% interest, do I put a note receivable on my books for 4% when my money costs me 5%? And the answer is no. If my money costs me 5%, I've got to earn at least 5% on any asset I put over here on the right-hand side of the balance sheet. I put on the left-hand side. So let's do a slightly complicating nuance. I not only approach my rich uncle, but I approach my rich brother. And he also lends me $10 million, but insists on 7% interest. So half my money costs me 5%, half my money costs me 7%. So my average cost of capital before taxes is 6%. So if a student comes to me and wants to borrow money for the home and wants to pay me 5.5% interest, I don't do that deal. On average, my money on the right-hand side of my balance sheet costs me 6%. I need to earn at least 6% on the assets I stick on the left-hand side. So that's the way we're going to look at a capital budgeting problem. Is Lucy Inc. going to put this machine on its balance sheet? Are they going to buy this machine? Well, if it earns more than what their money cost them, they'll do it. If it earns less, they won't do it. So in the rest of accounting class, we're worried about net income. But when we're talking about capital budgeting, or when you get to your business finance class, we care about cash flow. When do we get cash in so we can invest it in our business to make more cash? So let's create a little mini income statement and then turn it into an estimated cash flow project. So we're going to get new sales from this machine of $500,000. We're going to pay that poor guy $100,000 to run the machine, and we're going to subtract depreciation expense. The machine costs $2 million. We write it off over 10 years. Debit depreciation expense, credit accumulated depreciation, not cash. So depreciation is a non-cash expense. $5 million minus $500,000 minus $100,000 minus $200,000 means we have income before taxes of $200,000. Minus taxes at 40%, that's $80,000, means we have net income of $120,000. But in capital budgeting and in finance class, cash is king. So we're going to add back the non-cash expenses. In this case, depreciation expense is the only non-cash expense. So our cash flow from this new machine is estimated to be $320,000 a year. So now we know what this deal looks like. It's spend $2 million at time zero, get $320,000 a year for each of the next 10 years. There's no salvage value, no residual value, so there's no great big number out here when we sell it. So what do we do with this information? Well, one thing we can do is we could do the payback method. We could say, if I pay $2 million today, how many years before I get my money back? And it's about 6.25. So if our company says you have to get your money back within 6 years, we don't do the project. If they say it can be within 7 years, we do the project. But the problem is those are just arbitrary numbers that our company made up. A better way to do this would be to find the value today of these future dollars and compare them to what it costs to get them. And what do I mean by the value today? What I mean by the value today is the present value. So let me tell you another story. My ex-brother-in-law owes me $100. He says, Russ, I can pay you $100 today, or I can pay you $100 a year from now. Well, if I want to earn interest on that money, I need to have it. So if I can earn 2% interest, I will say, give me that money today, I'll put it in the bank, and I'll have $102 a year from now. Whereas if I just waited for you to give me the $100 a year from now, I'd only have that $100 then. So if he pays me today the $100, I can invest it, and a year from now I'll have $102. If I told him, okay, just pay me $100 a year from now, I would only have $100 then. The important part of this story is if he says to me, I know I owe you $100, I can either pay you that $100 today or $102 a year from now. In a 2% environment, I am indifferent. Both those numbers are the same to me. In other words, $100 is the present value of $102 to be received 1 year from now, assuming a 2% discount rate. And what we can do is we can find the present value of any lump sum or any annuity, which is the same sum received over and over again over every month or every year, or any cash flows. If it's got $100, $102, $103, $2,000, whatever it is, we can find the present value of that, either using algebra or tables like are in your textbook, or using Excel, or using the financial calculator. So, these are our cash flows. We need to find out what these future cash flows are worth today. And if they're worth more than $2 million, then we'll do the project. If they're worth less than $2 million, we won't do the project. So what do we know? We know the amount, we know the periods, we don't know the interest rate. What rate should we use? What discount rate should we use? And what we should use is our weighted average cost of capital. How much does our money cost us on the right-hand side of the balance sheet? And that's the interest rate that we'll use to find the present value of these future cash flows. Okay, half our money comes from debt. Remember, our company is capitalized 50% debt, 50% equity. Our debt costs us 3.33% before tax. But, just as cash is king, that's one principle today, the other is taxes influence business decisions. So we're going to look at everything after tax. The great news about interest is that it decreases our income taxes. It is tax deductible. What the hell do I mean by that? Let's look at this company here. They've got sales of $100,000, operating expenses of $50,000, operating income of $50,000, no interest expense because there's no debt. That means their taxable income is $50,000. Let's assume they got a 40% tax rate. 40% of $50,000 is $20,000, so that means their net income is $30,000. So now, let's take that same company and layer on $10,000 worth of interest expense. And I assure you that this net income will not go down to $20,000. It will not decrease by the full amount of that interest expense. Same sales, same operating expenses, same operating income. But here's that $10,000 of interest expense. That takes our taxable income down to $40,000. $40,000 times 40% is $16,000. $40,000 minus $16,000 is $24,000. So even though we added $10,000 worth of interest expense, the net income only went down by 60% of that, or $6,000. So we say that our after-tax effective interest rate is the pre-tax rate times 1 minus the tax rate. So instead of going down by $10,000, this company's net income only went down by $6,000. So when it comes to the Lucy Inc. example, their pre-tax interest rate on long-term debt is 3.33% times 1 minus the tax rate is 2%. So on the right-hand side of our balance sheet, our debt costs us 2% after tax. So half our money costs us 2%. What does our equity cost us? Well, it's riskier because equity investors have to wait in line behind the debt investors to get paid. So intuition tells us that its cost must be higher. But there's an interest rate on a piece of debt. There's no interest rate on a piece of stock. It just says 1 share of common stock. So one way to figure out what our equity cost is just to make a guess. We know it's supposed to be riskier, so let's add, say, 300 basis points. So in this example, that would mean 2% plus 300 basis points would be 5%. But that's just a guess, and it's not very scientific. A more scientific way is to say that the price people should pay for our stock is the present value of the future dividends. Well, if we know what our price is, and we know what we think people think our next dividend is going to be, and we think we know what our dividend growth rate is going to be, 1% or 2% a year, we can use algebra and solve for the required return. In other words, solve for the discount rate that our shareholders allegedly use when they buy our shares. And that formula looks like this. The required return is the next dividend we're going to pay divided by the current stock price plus whatever growth rate our shareholders are assuming. And the thinking is, if we don't earn that required return, investors will sell our stock. And if they sell our stock price will go down. So we'll use that required return as our quote-unquote cost of our equity. Unfortunately, Lucy Inc. doesn't pay dividends, so we can't use this method. We can use a thing called the capital asset pricing model. And that says if there's a risk-free rate out there, and in this case there's that 3% rate that the government is paying, there's no risk to that investment. There is a premium above that that will induce someone to invest in the stock market. If you're earning 3% now and I say, come invest in the stock market, you can earn 3%, you would not be interested. However, if I offer you a big enough premium, the potential to earn, say, 7% more, then you'll think about taking a risk and taking your money out of the risk-free rate. What we're going to do is we're going to adjust that general risk-free rate for investing in the stock market in general by a beta. And what do we mean by beta? Well, some stocks move exactly like the stock market. So if you look at their history, if the stock market went up 1%, our stock went up 1%. That is the beta of 1, the slope of this line, the stock we're interested in, plotted against the returns of the stock market in general, however you define that. If the slope of that line is 1, that's a beta of 1. A value line, which is an investment analysis service, estimates Comcast to have a beta of 1. Maybe our stock that we're interested in moves less than the stock market. So the slope of this line is less than 1. Verizon has a beta of 0.7. So we would require a smaller premium to invest in this particular stock because it moves less than the stock market. If it's got a beta of more than 1, that means it moves more than the stock market, so we're going to have to increase our premium. For example, Value Line estimates that Tenneco's beta is 1.75. On average, it moves more than the stock market, so I'm going to need more than that 7% premium above the risk-free rate to take this kind of risk because it's moving around so much. So the capital asset pricing model for this particular set of facts is the risk-free rate of 3% plus 1. Remember, Lucy's stock has a beta of 1. It moves just like the stock market. 1 times 7% is 7%. So 3% plus 7% is 10%. And since dividends aren't tax deductible, we don't have to worry about adjusting for taxes. So now half our money costs us 2%, half our money costs us 10%. So to find our weighted average cost of capital, 50% times 2 is 1, 50% times 10 is 5, 1 plus 5 is 6. If there were more debt, this 2% would get a higher weight. If there were less debt, it would get a lower weight. So our average cost of capital is 6%. Our weighted average cost of capital is 6%. If our money costs us 6%, we want to invest in projects that earn more than 6%. Okay, so now we know that 6% is the interest rate to use. Let's find what these future cash flows are worth at 6%. And if they're worth more than $2 million, let's go ahead and do the project. So let's do the simplest way of doing this calculation. These are all the same numbers. So we're in the third row, we're in the third row, we're in the third row. Hit second, clear time value menu. That clears everything out of our friend, the third row. And let's plug in some numbers. 10 is the end. In other words, there are 10 years in this problem. The interest rate we just spent a lot of time figuring out is 6% per year. PV is the present value. That's what we're going to try to find out. The payment is $320,000. Let's change that to a minus, just because when you put in negative numbers in a calculator, it throws out positive numbers when it comes to time value calculations. There's no future value because there's no big lump sum here at the end when we sell this thing out. It's got zero salvage value. So we'll hit compute PV, and sure enough, these cash flows in the future are worth $2,355,000 today. So we have a net present value of this minus this, or $355,227. So we're going to do that project. These future cash flows are worth more than what we have to spend to get them. All right, let's do the same calculation just a little differently. We'll use the dreaded CF menu. The problem with the CF menu is you don't get to see everything you put in, and so it's real easy to make a mistake and not realize it. So let's just be extra careful. CFO means what's the cash flow at time zero? Well, at time zero, we're paying out $2 million. Since that's cash out, let's put a minus on that. Change the sign down here and say cash flow at time zero is $2 million. Enter, down. Calculator wants to know what the first cash flow is. It's $320,000 in. Enter, down. Then it wants to know the frequency of that cash flow. Well, we get that 10 times. 10, enter, down. And that's all there is to it. There's no other future cash flows after that, $320,000. So let's find the net present value. Let's have it do that arithmetic we just did by hand. So we go into NPV and it says, well, what interest rate do you want me to use? We say 6%. Enter, down. And then we hit this compute button and it tells us that the net present value is $355,227, which is what we expected. We knew that these things were worth $2,355,000 and we had to spend $2 million to get them. So our net present value is $355,000. We do the project. Another way to do it is to find the internal rate of return. Officially, the internal rate of return is the discount rate at which the present value of these is exactly equal to that. But the easier way to think about it is what this project earns. So if it earns more than 6%, we do it. If it earns less than 6%, we don't do it. Let's go to the dreaded cash flow menu again. Let's stick in the cash flow times zero. Remember, it's $2 million. It's dollars out, so let's plug it in as a negative. Then we'll go down. It wants the first cash flow. Well, the first cash flow is $320,000. Enter, down. And then how many times do we get it? 10 times. Enter, down. Nothing else to enter. And now we'll hit IRR, compute, and it's 9.6%. So this project earns 9.6%. Our money costs us 6%, so we do the project. Big picture, what we're going to do on a capital budgeting problem is figure out what our money costs us on the right-hand side. We're going to have to look at debt and an after-tax basis. We're going to have to make a guess at equity because there's no interest rate hanging out on a stock certificate. And once we find our weighted average cost of capital, we know what our money costs us, and we can find the present value of the future predicted cash flows from the capital project. And if the present value of those future cash flows is greater than what we have to spend, we do it. If it's less than what we have to spend, we don't do it. And that's all there is to capital budgeting. I hope that helps.